In this video, we'll be discussing additional economic information, specifically the Federal Reserve minutes and the PCE inflation report. The PCE inflation report, released on February 24th, was surprisingly high, even more so than the CPI, which was at 6.4% in January, a disappointment as it barely decreased from 6.5%. On the other hand, the Personal Consumption Expenditures Price Index gathers information from businesses and is the Federal Reserve's preferred measure of inflation. While they still consider CPI, they prefer to use PCE, and the latest PCE report released this morning indicates an increase in the inflation rate, and it employs different formulas and weights than CPI to track various expenses. Let's delve into the latest economic data, starting with the PCE inflation rate, which climbed from 5.3% in December to 5.4% in January, and core inflation followed suit, rising from 4.6% to 4.7% over the same period. In addition to this, both CPI and PPI showed similar negative trends. Moving on to the Federal Reserve, we have the Fed minutes, a detailed record of their meetings that is released approximately 3 weeks after the meeting concludes. At their last meeting on February 1st, the Fed increased interest rates by 0.25%, a significant change from their previous rate hikes of 0.75 and 0.5%. This decrease was due to a relatively rapid drop in inflation, which was good news for the economy. Fed Chair Jerome Powell seemed confident and relaxed during his post-meeting press conference, which the stock market loved. However, February 14th brought a shift in the economic landscape. On Valentine's Day, the January CPI inflation report was released, showing that inflation had stopped decreasing at a rapid pace. This was before the Fed minutes from 3 weeks ago, which revealed that the Fed wants to bring down inflation to 2%, but it is still considered unacceptably high and is affecting lower-income households the most. However, the Fed expects inflation to decrease significantly this year, despite the fact that there is less evidence of a slowdown in services. Inflation for goods has decreased significantly, but inflation for services appears to be more stubborn. The Fed believes that as long as the labor market remains tight, wage growth will continue to put upward pressure on prices. Over the past 3 months, average hourly earnings grew at a rate of 4.1%. With inflation rising faster than wages, it means that the purchasing power of Americans is decreasing. Despite this, the media seems to avoid talking about it. In fact, the Federal Reserve stated in the Fed minutes that they need to bring down wage growth in order to reduce inflation. This implies that inflation will continue to outpace wage growth, which will negatively impact Americans. To tackle this, the Fed plans to increase unemployment so that businesses will not have to compete fiercely to hire potential employees, resulting in lower wage inflation and inflation overall. At the February 1st meeting, the Fed members did not know about the January inflation results, which indicated that inflation was no longer decreasing as quickly. During the meeting, almost all of the Federal Reserve members agreed to raise interest rates by 0.25 instead of 0.5% to slow inflation down. They believed that this approach would better allow them to assess their progress towards achieving their goals. However, some members still prefer to raise interest rates by 0.5%. The Federal Reserve also pays close attention to the stock market and discussed it extensively in their minutes. According to the minutes, stock market indexes were slightly higher and market volatility declined, but remained slightly elevated. The VIX decreased somewhat, but remained slightly above the median range of its historical distribution. Additionally, the forward price-to-earnings ratio for the S&P 500 remained above its median value, despite the decline in equity prices over the past year. Despite saying that the stock market does not affect their decisions, the Federal Reserve's close monitoring of it suggests otherwise. The Federal Reserve officials are closely monitoring stock prices, the VIX, and PE ratios, which is not surprising given their history of insider trading scandals. Despite the media's optimistic outlook on the economy, the Fed minutes suggest that the probability of a recession in 2023 remains high, and that a period of below-trend growth in real GDP will be needed due to the unacceptably high inflation. This means that more economic damage will be necessary to control inflation. According to the Federal Reserve's minutes, the Q4 GDP growth in the U.S. was driven by a large inventory gain and a significant contribution from exports, both of which are volatile categories. Additionally, U.S. manufacturing output declined substantially in November and December. Although the boost to GDP from inventory investment is not expected to continue, distortions in the data make the U.S. economy appear stronger on paper than it actually is. The government reports are distorted and exaggerated, and that the Federal Reserve needs to bring down the inflation rate, which currently stands at 6.4%. Legitimate data should be presented, and that the truth should be told to the public. If inflation does not fall soon, it could be a cause for concern, as evidenced by the increase in the February inflation report. If the February inflation report shows 6%, it would be brutal, while 6.1% would be bad. However, if it shows a 6.2% or 6.3% increase, it is uncertain what the Federal Reserve will do at their next meeting on March 22nd. Powell will probably be in a hawkish panic. The February inflation report is expected to be terrible because the labor market remains tight, and China's reopening will spike commodity prices and by extension increase inflation. Be sure to subscribe, and thanks for watching.